Hey everyone, I'm Keith Hill, and today we're diving into the secrets of picking the best dividend stocks for 2025. Whether you're new or experienced, these strategies will help you build long-term wealth. Dividend investing is about consistency and turning your money into a reliable cash flow machine. If you're serious about financial freedom, hit like, subscribe, and turn on notifications. Let's jump right in. The first thing to look for when evaluating dividend stocks is consistent dividend growth. This means not just receiving a payout, but seeing that payout steadily increase over time. Don't just chase high yields. Find companies with a solid track record of raising dividends year after year. High yields can be tempting, but they're often unsustainable and may signal underlying problems. Instead, focus on dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. These businesses have weathered economic downturns and market volatility, proving their resilience and commitment to shareholders. Reinvesting growing dividends creates a powerful compounding effect. Over time, your returns can snowball as each dividend increase boosts your future income and investment growth. When researching, scan for at least a 5 or 10-year streak of uninterrupted dividend hikes. This kind of consistency is a strong sign of a company's financial health and disciplined management. Moderate, steady increases are healthier than big, unsustainable jumps. A company that raises its dividend by a reasonable amount each year is more likely to maintain that growth in the future. Consistent growth signals management's confidence in future earnings. It shows they believe in the company's ability to generate profits and reward shareholders over the long term. It also helps protect your income from inflation. As the cost of living rises, growing dividends can help your purchasing power keep pace, ensuring your income doesn't lose value over time. While past performance isn't a guarantee of future results, a long history of increases is a strong indicator of stability and reliability. It suggests the company is committed to rewarding its investors. Before adding a stock to your portfolio, ask yourself, has this company made a habit of increasing its dividend even during tough times? This habit can set it apart from less reliable options. Consistent dividend growth is a cornerstone for reliable long-term income. It's especially important for those planning for retirement or seeking financial independence. Make it a priority in your portfolio, and you'll be building a foundation for lasting wealth and financial security. Next, let's take a closer look at the payout ratio, one of the most important numbers for dividend investors. The payout ratio tells you what percentage of a company's earnings are being paid out to shareholders as dividends. In other words, it shows how much of the company's profits are being returned to you, the investor, versus how much is being kept to reinvest in the business. A healthy payout ratio, usually between 40% and 60%, means the company can sustain and even grow its dividend over time. This range suggests the business is striking a good balance, rewarding shareholders while still keeping enough earnings to fund future growth, pay down debt, or weather tough times. If the payout ratio is too high, say above 70% or even 80%, it means the company is paying out most of its profits as dividends, leaving little room for error if profits fall. This can be risky, especially in industries where earnings can fluctuate. On the other hand, if the payout ratio is too low, the company might not be sharing enough of its success with shareholders, which could be a sign of overly conservative management or a lack of confidence in future earnings. It's also important to remember that payout ratios can vary widely by industry. Some sectors, like utilities and real estate investment trusts or REITs, can support higher payout ratios because they have stable, predictable cash flows. In contrast, tech companies or those in cyclical industries may need to keep more cash on hand, resulting in lower payout ratios. That's why you should always compare payout ratios among companies in the same industry, rather than across different sectors. What's considered healthy for a utility might be unsustainable for a tech startup. Pay close attention to trends over time. If you notice the payout ratio is rising while earnings remain flat or even decline, that's a red flag. It could mean the company is stretching to maintain its dividend, which isn't sustainable in the long run. Ideally, you want to see a stable or slightly growing payout ratio supported by rising earnings. This signals that the company's dividend growth is backed by real profit growth, not just financial engineering. If you come across a payout ratio that's unusually high or low, don't just take it at face value. Dig deeper into the company's financials and recent news to understand the reasons behind it. Sometimes, a temporary dip or spike in earnings can distort the ratio. Think of the payout ratio as your early warning system. It can alert you to potential trouble before a company actually cuts its dividend, giving you time to react and protect your investments. By monitoring this metric, you can avoid companies that are at risk of cutting their dividends, which can lead to sudden drops in share price and lost income. Protect your income by making sure the dividends you rely on are built on a solid foundation of real, recurring earnings, not just accounting tricks or one-time gains. So, before you invest in any dividend-paying stock, always check the payout ratio. It's a quick and powerful way to gauge the safety and sustainability of a company's dividend. Taking this simple step can help you avoid nasty surprises and build a more reliable, resilient income stream for the future. Strong financial health is the backbone of any great dividend stock. Before you invest, it's important to dig deep into a company's financials to understand how well it can support its dividend payments, not just today, but for years to come. A company's ability to pay and grow dividends depends on the strength of its balance sheet and the consistency of its earnings. Look for companies with more assets than liabilities and manageable debt. A healthy balance sheet means the company isn't overburdened by what it owes and has enough resources to handle unexpected challenges. Excessive debt can put dividends at risk, especially during economic downturns. Consistent positive free cash flow is essential. Dividends are paid with real cash, not just accounting profits. If a company regularly generates more cash than it spends, it's in a strong position to reward shareholders. Watch for companies that can sustain their cash flow even when business conditions get tough. High return on equity and stable operating margins signal a competitive advantage. These metrics show that management is using resources efficiently and the business can withstand competition. Consistent profitability is a sign of a well-run company. Check credit ratings from agencies like Moody's or S&P for extra reassurance. Investment-grade ratings indicate the company is less likely to default on its obligations, which is especially important for income investors who rely on steady dividends. Watch for red flags, declining sales, shrinking margins, or rising debt. These warning signs can signal trouble ahead and may lead to dividend cuts or suspensions. Always be cautious if you see a pattern of deteriorating financials. Compare financial health to industry peers for context. A company might look strong on its own, but it's important to see how it stacks up against competitors. This helps you spot leaders and laggards in the sector. The best dividend stocks aren't always the highest yielders, they're the most financially resilient. A high yield can be tempting, but it's only sustainable if the company's finances are solid. Focus on quality over quantity for long-term results. Stable revenues and profits mean dividends are more likely to keep coming, even in tough times. Companies with a track record of weathering economic storms are more likely to protect your income stream. Don't skip the homework on financials. Take the time to review annual reports, quarterly earnings, and management commentary. Understanding the numbers gives you confidence in your investment decisions. It's not flashy, but it's crucial for long-term success. Careful analysis now can help you avoid costly mistakes later and build a portfolio that stands the test of time. A rock-solid balance sheet is your best defense against dividend cuts. Companies with strong finances can keep paying dividends, even when the economy hits a rough patch. Make sure your picks can weather any storm. By focusing on financial health, you'll set yourself up for reliable income and peace of mind no matter what the market brings. Industry stability is key for reliable dividends. Sectors like utilities, consumer staples, and healthcare are naturally more stable. People need these services in any economy. These industries offer predictable earnings and are less likely to cut dividends during downturns. Cyclical sectors like energy or luxury goods can be riskier. Dividends may fluctuate with the economy. Look for industries with staying power and adaptability to change. Consider regulatory environments. Some, like utilities, are protected but may have limited growth. Global diversification can add another layer of stability. No industry is risk-free, but some are much safer for dividend investors. Focus on sectors with a track record of weathering economic storms. This boosts your chances of steady, uninterrupted income. Make industry stability a core part of your selection process. It's another layer of protection for your portfolio. Even the best dividend stock can disappoint if you overpay. Valuation matters. Look at metrics like PE, PB, and dividend yield versus historical averages. Don't chase hype, sometimes the best buys are undervalued or overlooked. Compare valuation to industry peers for context. A high yield can signal trouble ahead, a low yield might mean the stock is overpriced. Aim for a yield that's attractive and supported by fundamentals. Dollar cost averaging can help smooth out market ups and downs. Valuation is your margin of safety, don't ignore it. Protect yourself from overpaying and give your investment room to grow. Always ask, am I paying a fair price for future dividends? Smart valuation decisions set you up for long-term success. Make this a habit before every purchase. Management can make or break a dividend stock. Look for teams with a history of paying and raising dividends even in tough times. Smart capital allocation and responsible borrowing are signs of strong leadership. Transparent communication, especially during challenges, builds trust. Insider ownership aligns management's interests with yours. Compare management's performance to industry peers. Consistent outperformance is a good sign. Watch for red flags, legal troubles, scandals, or frequent executive turnover. A great management team protects and grows your dividends. Don't overlook this factor. It's often the difference between success and disappointment. Leadership sets the tone for the company's future. Make sure you're investing alongside people you trust. Strong management is the glue that holds your investment together. Diversification is your best defense against risk. Spread your investments across sectors like utilities, healthcare, tech, and consumer staples. Geographic diversification protects against local economic shocks. Mix large-cap blue chips with select mid- and small-cap stocks for growth potential. Consider dividend-focused ETFs for instant diversification. Monitor and rebalance your portfolio regularly to maintain balance. Diversification isn't about owning everything, it's about building resilience. No single investment is bulletproof, but a diversified portfolio can weather market ups and downs. Keep your income steady by not overexposing yourself to any one area. The extra effort pays off in peace of mind and stability. Make diversification a core strategy for 2025 and beyond. It's the final piece for a winning dividend portfolio. Stay disciplined and keep your portfolio balanced. Let's recap. Focus on consistent dividend growth, healthy payout ratios, strong financials, stable industries, reasonable valuations, trustworthy management, and diversification. These are the building blocks for finding the best dividend stocks in 2025.